And interestingly, economic analysis of financial regulation, as we have seen in some of our previous sections, you probably now have a view with respect to the financial system itself. And you know that the financial system is the one of the mostly regulated sectors of the economy, and within the financial system, probably the banks that get more concerns in terms of regulations. But there are other sectors also. For instance, you will have health, education, defense. Those also comes under significant regulations by countries. But financial system, financial sector, and the banks is also one of the mostly looked after in terms of regulations are concerned. So in this section, we are trying to develop an economic analysis, because from a perspective, entire course that we are studying is we are trying to interpret the economic perspectives of financial markets and the monetary policy. And monetary policy itself, its economic perspective, but we'll come to that point. And we wanted to see this economic analysis of why these regulations of financial markets, particularly banks, take the form that you are familiar with, if not you are trying to understand today. So whatever said or done, despite all these regulatory arrangement, you may have seen there are difficulties in financial system at different periods of time. Now, for instance, we discussed in detail about the financial crisis, and you've probably seen how that has stressed the entire global financial system, and some financial intermediaries collapsed. This, in spite of all these regulatory arrangement in place, right? So, as evidence that you have seen in recent crises, the banking systems, the financial market across OECD countries, including frontier, developing, emerging market, basically the entire globe had these stresses felt, right? So in this section also we use some economic considerations in terms of banking regulations to explain the worldwide banking crisis from one perspective, and how the regulatory system can be reformed in the future to meet, if not address, some of the challenges that the financial system face. So this section is not only in terms of analyzing the regulatory considerations in terms of economic perspectives, but also we try to kind of explain and try to understand what form of changes would require in the near term to see how best the banking systems could withstand, if any, challenges of the proportions that we discussed in financial crisis of 2008-9, if it reoccurs. So there is no assurance, despite the all these regulations, the banking crisis, if not financial crisis, would not occur. Despite all these regulations in place, you have seen how many crises we have only discussed in detail about the global financial crisis, but you had the Great Depression, then you had the different episodes of crisis in East Asia, Latin America, and different countries at different points. So this crisis could happen, can come at any time, despite all the efforts that we have put in place in terms of these regulatory measures. This being said, you already know the asymmetric information. This asymmetric information and financial regulation goes very much hand in hand, right? So most of the problems that we come across is not because of anything, but because of asymmetry. Either non-availability of information or availability, but not necessarily in the full scale one might require to review, analyze a financial position of an agency, right? So the consideration in terms of the financial regulation first arose in terms of bank panics and the need for deposit insurance. The bank panics, it's effectively not necessarily a crisis or a collapse of a bank, but people are panicking. People are worried of their deposits they have placed with financial intermediaries. So everybody tries to withdraw the deposits held with financial intermediaries, possibly in the same go. You can see from this picture in this slide the war of wealth. And this is very interesting. I mean, you can read these books if you can figure it out. If you have leisure time, please read. So that would say to the extent how people panic, even in developed countries, when they were misguided, if not available to have information to conclude that they are exposed to a crisis of this magnitude, right? The thing is, I mean, with all these arrangement in place, still you see the people are worried in terms of their deposits, because most of the time this may be their life long savings. So everything depends on what they have placed with these financial intermediaries. But this panics has created an environment where even if the banks are sound and can manage their affairs, because of these panics, they will not be able to withstand the pressure of depositors withdrawing their deposits, right? So when everybody comes at one and the same time and try to pull out their deposits, the banks would not be in a position to pay them, because they probably use some of those resources to create assets in their books. So those assets are either in funds, investments in securities, investments in real assets, investment in other forms of assets, but mostly in loans. And these loans are either long-term or even short-term. But most of the long-term loans you cannot recall overnight. So what you simply is, when the financial intermediaries find the liquidity problems immediately. That means the liquid assets that they have in their portfolio is not sufficient to meet the people who are queuing up to withdraw. So you probably keep 10% of your deposit portfolio in liquid, and maybe out of that 10, maybe 9% in, let's say, government papers. But even you have to go and cash these government papers. You have to sell in the market and get these government papers converted to ready cash to pay depositors, right? So these bank panics have created an environment where even the healthy status of financial intermediaries turn into a very stressful circumstances and need to depend on third parties to meet their immediate liquidity requirements. So one way of addressing these panics was the deposit insurance. So you've been given a deposit insurance. So you now realize there's a panic. People are queuing up, withdrawing. But you also aware to the extent where you have insurance, in the event of anything happens to your deposits, you can rely on the insurance. Sometimes this insurance is for the full amount of your deposit. For instance, below a certain value, let's say 1 million rupees. So below 1 million rupees, the deposit insurance covers the entirety of your deposits. right? Above 1 million, first 1 million is covered, second 1 million 80%, third 1 million 60%. Likewise, it differs. It depends on type of insurance that you are entering with. So the financial intermediation has created, even in Sri Lanka's case, there's a deposit insurance arrangement now, especially the full amount being covered below a certain threshold. It was about 600,000 some time back. I'm not precisely sure what's the exact value now. So you see that deposit insurance at least gives some cushion for some of the depositors, not necessarily queuing up in front of the financial intermediaries. And also today's context, you don't need to necessarily queue up in front of the financial intermediaries, but you have electronic arrangement to transfer your funds. Right? So when the panic sets in, it's also become very different. So the deposit insurance first established in the form of so-called FDIC, Federal Deposit Insurance Corporation arrangement. Okay, so what you are seeing here is FDIC, Federal Deposit Insurance Corporation. So the FDIC short circuits the bank failures. So effectively, that prevents the bank panics spreading to rest of the financial system. So bank A has the problem. So the FDIC tries to kind of solve the problem of bank A without letting that financial panic or the bank panic spreading out the rest of the financial intermediaries. So the entire financial system would be in a jeopardy if that happens. So the FDIC was first introduced with that purpose. This is effective safety net, government safety net. Okay, so basically what safety net is, if you fall, there's a net to protect you. So very much of that nature. So your deposits are in jeopardy. The deposit insurance would come and safely help you to have your deposits be withdrawn. So the government safety net for depositors can short circuit runs on banks. Runs on banks mean withdrawing funds that the people deposited with financial intermediaries, and also bank panics without having realistic reasons to worry. People start panicking simply because of various asymmetries, maybe even wrong information, but still people panic. So this is the asymmetry. And then you find by providing this safety net, if not FDIC, this protect the depositors, and it can overcome reluctance to put funds in the banking system, because people are worried, especially during the Great Depression, that their deposits would be in trouble. Not only that, they were not trusting. Basically, they distrust the financial intermediation because they worry if we save, if we deposits, they'll not be able to withdraw as required. So that a factor of mistrust or distrust about the financial intermediation was put on hold by the introduction of FDIC. And effectively, this had some elements of insurance, deposit insurance, even prior to the Great Depression. But there are ways through which initially this was discussed. One is payoff method, that is the paying in the event of a banking crisis in the order of liability. What I'm talking is FDIC. FDIC is a Federal Deposit Insurance Corporation. So they have certain elements in terms of settling when the panics and with bank runs happens. But the FDIC was introduced to avoid these panics and thereby short-circuiting the bank failures. So this was effectively the kind of arrangement prevailed. And I simply see the developments in terms of the arrangement subsequently you will see with our discussion, it expands and develops. But originally, there were systems, even in the case of bank panics, short-circuiting bank problems, they've been trying to settle through certain arrangements in the form of payoff methods. There are certain methods where you line up your liabilities, the highest priority being given to certain type of liabilities in settlement, right? So all the deposits are liabilities of financial intermediaries, right? So you deposit, it's a liability in the books of financial intermediary. But interestingly, the settlement of these financial liabilities also been arranged in a way that the people who are having priorities, for instance, within investments as shares, normal or the common shares versus preferential shares. The preferential shares get priority in payment of organizations' profits, right? So that's a way in which the payoff method's been defined. So what you are basically seeing is the payoff method, and there was another system called purchase and assumption method. This is effectively that the Deposit Insurance Corporation, they take the financial intermediary and they try to reorganize, like you are pooling with some other financial intermediaries' books and then letting the arrangements to work through, not necessarily settling the obligations, maybe settling, but maybe they request depositors to have, let's say, deposit withdrawals being capped for a certain amount, even requesting them to not withdraw for a certain duration. These are possible, but what the purchase and assumption method is, they try to reorganize the bank, either creating a joint venture or a collaboration with another financial intermediary. There were efforts of similar nature even in the case of Sri Lanka, but there was no bank run as such in the case of Sri Lanka. But some time back, there were circumstances where people were pushing to withdraw. So the financial intermediary was again placed with another strong financial intermediary. So they've been given the management rights for a certain. These also a way in which the deposit insurance kind of arrangements been presented. But in a more technical sense, the purchase and assumption method refers to reorganization of the financial intermediaries. And then you see other form of government safety nets. The lender of last resort facilities is what other forms mainly shapes up. So the lender of last resort facilities, you go to your godfathers, right? So effectively what you are seeing here is the central banks acts as godfathers for most of the financial intermediaries. When you have difficulties, you come to the central bank. You have the financial arrangements in terms of giving facilities to some of these agencies in the form of liquidity. So you have windows, open market operations windows. You have overnight lending facility, or you have a lender of last resort facility, that is a window where you give the banks with certain credit arrangements at a interest cost, yes. But at the same time, first you've been asked to kind of, source your funds from the market itself. But the market participants, other financial intermediaries, would not necessarily ready to lend due to various considerations, limits, exposure limits. The banks exposed to other bank in terms of volume, how much that you will be doing. For instance, in the case of Sri Lanka, call market, call money market. The banks are lending to other banks without taking any collaterals. Underlying security, they don't take. So it's a matter of just transferring your excess funds to the financial intermediary. But then the limits being set. For Bank A, my limit is 100 million. Bank B, 500 million. Bank C, 2.5 million. So they have steps based on the bank size, bank's creditworthiness, and their own evaluation. But when it comes to asymmetry, even if there's this information available, banks would not necessarily believe in this information and try to kind of see loopholes in information, and they try to have additional cushions being established. So the form in which that the safety net being defined at difficult times of financial stresses falls on the shoulders of central banks. So the central banks still lend some of these liquidity arrangements through the windows. Of course, central banks might ask you to keep your securities, let's say government securities. Otherwise, you can sell these government securities in the market. You will be getting a highly discounted prices. That means very low prices, simply because everybody is worried to lend to this financial intermediary. So this financial intermediary might not get the required volumes of finances from the markets in such circumstances. So what happens here is the central bank would come and cushion them out by giving lending arrangements, overnight lending for liquidity, term lending for liquidity and other consideration, or lender of last resort. So everything else fails, you come to the central bank, and the central bank, even by pledging their buildings and other type of assets, they'll be able to get these facilities. And up to a certain point, but then of course central bank also would require these agencies to look into reorganizing, if not changing the treasury operations model. And through such arrangements, try to kind of work through these back into more realistic existence. So this is the way in which the safety nets and other forms of insurance try to kind of reduce the possible panics or bank runs that happened in the past. Also, to some extent now been more modified to say the same arrangements being facilitated to prevent the panics and runs on financial intermediation. Then, of course, the problems with these safety nets, when you have somebody to, bail you out, if not when you are falling from a position or a place, somebody is there to kind of hold you. You become a little more complacent, right? So this is the moral hazard problems. So moral hazard, what and how moral hazards takes place now. So moral hazard occurs when one person takes more risk because someone else bears the burden of those risks, right? So now there's a safety net. It's not only the depositors, but also the management of financial intermediaries. So principal agent problem is that's the other side of the equation. But at the same time, you find here, when you see this moral hazard, right, they know somebody is there, safety net is there, federal deposit insurance arrangement is there, a lender of last resort facility is there, liquidity arrangements in the form of overnight term facilities are there. So the financial intermediaries make use of these arrangements, and then go beyond their legitimate perspectives of risk taking, and of course taking more risk because higher the risk, higher the return. You know that from the very first lecture that we started for this semester, right? So when you see that the opportunities, they take that additional risk. So the additional risk is taken because they expect additional return. So that's the management perspective. Even depositors' perspective, depositors think, okay, somebody is paying me higher return, higher interest rate. So I'm going behind that particular financial intermediary, irrespective of looking into the details of that financial intermediary's books and the sustainability from another perspective. So you see this moral hazard naturally creates when somebody puts a net to get you protected from falling from a building. So similar to that, financial intermediation, when they have this safety net, so the moral hazard set in. So the moral hazard may occur where the actions of one party may change to the detriment of another. This is upon the financial transaction, not before, but after the financial transaction. So from a depositor's perspective, they do not impose the discipline of marketplace. So what happened here is depositors would not necessarily look into the details of the financial intermediary, changes happening in financial intermediary, the nature of businesses change in the nature of businesses they engage, type of investments they prioritize, right? So if the depositors impose discipline, what they would do is when they see that this financial intermediary is not taking adequate measures, they slowly take their finances out, the deposits out. So that itself create a kind of a signal to the management to see that they have to change course, change action to maintain their the market discipline in terms of how best to manage the finances of this financial intermediary. Okay, and from another perspective, financial institutions, they themselves have an incentive to take on greater risks. As I was mentioning, higher the risk, higher the return. So the principal agent problems. Agents are maximizing their return by bringing in elements of risky investments into the portfolio, because they know a higher return would give them higher opportunities for bonuses related benefits, and also possibly making them successful in terms of having greater resources in their disposal. So to say that moral hazard is again a problem, because you provided the so-called safety net for the financial intermediaries. Then the adverse selection. So the asymmetry that we discussed previously in our previous discussions repeats again and again in terms of these financial intermediaries and the financial market. So the adverse selection occurs when buyers have better information than sellers, you know that, and so the highest cost consumers end up buying a particular product. So effectively, because of this possible adverse selection, risk lovers, because they simply think financial intermediaries basically reduce the risk that they take on their own, because financial intermediaries pool most of these people and price in a way to balance the risk lovers, everybody. And risk lovers naturally are kind of, benefited, because they also being looked at in the form of general market circumstances. So the adverse selection happens here. So you pick more or less the wrong clientele. So the wrong clientele would not necessarily do justice to the financial arrangements the financial intermediary entered with the clientele, but they are taking more risks than what is ought to be. So from another perspective, depositors also have little reason to monitor financial institutions. So the depositors' perspective, you have now picked the bank. So you have deposited, you drive your salaries to that account, but still you need to monitor what this financial intermediary is doing, because your money at risk, your money at work from another perspective. So you have to make sure that these agencies do justice or take risk levels which are reasonably all right. Of course, the financial regulations look into those, but the financial regulations come to that point upon most of these yardsticks that requires to be established by the so-called concept self-regulation. So that has to come in. So the adverse selection from a depositor's perspective, that depositors do not necessarily keep required reviews, monitoring with respect to the financial intermediaries with whom they have financial interaction. So then another a safety net problem is too big to fail, right? So you are systematically important financial intermediary. So when you are systematically important financial intermediary, you find the governments are often trying to protect you from meltdowns. So basically, you are seeing here the financial intermediation. Financial intermediation and seeing to the extent where the consideration in terms of the safety net would not necessarily be effective because these agencies are systematically significant for a country to protect. So the country's arrangements say that this agency is too big and too important and systematically spread out to all the economic activities in the country. So the government or the administration provides certain guarantees to clientele in the form of repayment to kind of a creditors or the depositors from another perspective, and also these guarantees would sometimes assure you that the financial intermediaries' failures, irrespective of financial intermediaries' failures, the government would make sure that the depositors are protected. I mean, even in the case of Sri Lanka, there are certain financial intermediaries whose deposits are guaranteed by the government, right? So I'm not naming those, you know, you can it out. So the element here is the concept of too big to fail. These agencies have spread it out to the extent every nook and corner of this country been covered, and they simply think their existence is necessary. Let's say to facilitate utilities, to facilitate payments to a certain segment of the society, payments to underprivileged groups of people. There are various ways through which this too big to fail concept could come in. But interestingly, what you are seeing here is here, to some extent, at times of trouble, if these too big to fail financial intermediaries also come to a point where they are also about to collapse, the purchase and assumption method is often used. They do not, the governments do not let these agencies to collapse. They try to amalgamate them, introduce joint ventures, try to protect with some other arrangement. So the FDIC that you looked at payoff method, the purchase assumption method, often they use purchase and assumption method, reorganize these agencies in the form of arrangement with collaboration, joint ventures kind. So you see these arrangements, but unfortunately, this increases, if not this pays incentives for big financial intermediaries to have more and more moral hazard possibilities. They know that whatever they do, they would not be penalized. They would be looked after. They'll be protected by the safety net. So that itself creates incentives for them to take more risk. And from another perspective, not necessarily managing their portfolio and their financial arrangements. So this is a real challenge in today's financial markets, because there are agencies, they are increasingly expanding into all the forms of activities that required in a financial market. And through such expansion, they have created a kind of network that cannot be dismissed directly by regulators or the governments in the event of difficulties by these agencies. And also, when the government imposes penalties, government imposes penalizing arrangements, that also to be kind of a review from the perspective of the impact to its overall operations. So this is something now take priority in financial supervision and financial regulations discussion all around the world. And there are papers to the extent new papers, new literature. You also can read if you get little leisure time in terms of the safety nets and too big to fail. Are we in the right direction? There are various ways through which these been discussed in the literature. So you can explore, you can try to kind of figure out and try to see how best this been matched with today's consideration. So this being said, one form of a government safety net which also contributed to this too big to fail type of financial intermediation is so-called financial consolidation. Right? So you see financial consolidation, even in Sri Lanka, some time back, you have seen there's an aggressive push for financial consolidation. They want smaller financial intermediaries, particularly not in the banking sector, but let's say finance and other forms of activities. They've been asked to, they've been encouraged to consolidate. Effectively, is right, because those agencies do not have economies of scale in their operations. They only serve to a certain clientele, and that clientele, because of its small nature, actually exposed to a higher risk from a different perspective, and also they pay a higher interest cost when it comes to financial services obtained from these agencies. So what you are basically seeing here is the consolidation itself has created larger and more complex financial organization which challenge the regulation. So you have regulation in place, regulators put regulation in place to make sure a concentration of financial intermediary activities being managed, kind of diversified to extent where risk would not concentrate to one particular epicenter. But unfortunately, so-called consolidation gave way to kind of, creation of more complex financial organization. And as a result of this, a too big to fail problem further expanded, further enhanced. So you are basically seeing here the financial intermediation has its benefits through consolidation, but at the same time, there is a requirement to monitor to what extent this would create so-called too big to fail financial intermediaries. Okay, so this too big to fail consolidation-based creation of complex financial organization has extended this safety net to new activities. So, for instance, you let consolidation happen in commercial banking, consolidation happen in specialized banking activities, the deposit insurance type of activities, insurance type of activities, lease, right? Trade services, securities, and capital market investment perspective. So what happened here is you have created new activities and pooled them together. And as a result, the safety net has been expanded, extended to activities which were not falling under the safety net previously. Okay, so as a result, you further increase incentives for risk taking by these agencies. Right? So this is to some extent happened during the financial crisis, where the financial engineering, financial innovation has contributed to kind of a pool number of CDOs, and the financial intermediaries linked up with mortgage firms and mortgage, financial intermediation, and then real estate. All being kind of brought into the central bank's safety net and government safety nets. In the case of US, they have not only the Federal Reserve's cover, but at the same time, based on the states to which that financial intermediary is responsible, there are other mechanisms also. We will discuss that in coming weeks when we come to the central banks and the Federal Reserve System. So what I'm simply trying to say is, yes, safety net is good. Safety nets creates a lot of positives to the financial intermediation and the confidence of people on the financial intermediation. But at the same time, this could create moral hazards and adverse selection problem. And then, of course, too big to fail is another outcome in terms of a lot of considerations that we listed. And from another perspective, financial consolidation also contributes to too big to fail type of financial intermediaries to establish, and thereby possibilities of effectiveness of government safety nets. So that's a very interesting area where you have to keep your eyes and then considerations on, because this is repeatedly discussed at different forums. Even today, this has been discussed given the current pandemic kind of challenges. Right. So then we'll come to this point. Before that, any questions you have before I move on? Right. So if you don't have questions, yes, I'll move on. I'll move on to the yes, please. If somebody wants to clarify anything.
So I didn't understand what is moral hazard.
Right. So it's a very preliminary question, I believe, because we discussed this many times in our previous discussion. But to
sorry, actually, I couldn't follow those. I just joined last week.
Okay. So moral hazard is, right, from your perspective, right? So you have somebody to protect you. Very simple, huh? You have somebody to protect you. So because of that, you don't take care of your responsibilities, because you know somebody is there, so he will protect you. So moral hazard also same. So you have medical insurance, right? So you don't necessarily take all precautions that required because you know in the event of hospitalization, the medical insurance will cover. Similarly, we have medical insurances coming from our organizations. Sometimes, yes, most of you all work in financial intermediaries for that matter. They provide you medical cover. So as I was explaining in our previous discussion, you probably seen towards the latter part of the financial year, there are quite a lot of tests in terms of dental checkups, full body checkups, general medical, because it's nothing you need to do. Just because the facility is available, people go and do that. Same thing with full insurance. So when you have full insurance for your motor vehicles, you become careless to some extent, right? Or from another perspective, I was explaining, when you be provided with official motor vehicle, you probably little carefree than you are using your own motor vehicle, right? So similarly, people live in rented houses versus their own houses. They've been little carefree. So the moral hazard is nothing but you take risks beyond what you should be taking. And even in today's handout, if you look at the slide number 4, you have a moral hazard consideration with respect to government safety net. Within bracket, you can see moral hazard occurs when one person takes more risk because someone else bears the burden of those risks. Who bears the burden of the risk that you are taking here? either organization, somebody is there to protect you. It's like that. So when the central banks look after these banks as the lender of last resort or liquidity facility, these financial intermediaries do not take the required precautions or required analysis, required reviews before they invest in certain type of assets. They go behind higher risky assets because higher risk means higher returns. Higher the risk, higher the return. I mean, that's kind of a motto we discussed at the very first lecture. So lower the risk, lower the return. People become risk averse possibly because they are mindful of the protection of the finances that they put into a financial intermediary. So they might not get the return like somebody who put it to a financial who pays higher return. Higher return is fine as long as the required reviews, protections being established. If not, that's a risk element. So risk need to be also factored in the equation of return computations. So the moral hazard is nothing but you take risks beyond the risk that you should be taking simply because somebody else is there to bear the burden of those risks. Okay, so the moral hazard happens before a transaction. Sorry, once you have the transaction, adverse selection is before the transaction. Moral hazard is after a transaction, right? So you have the insurance, you become a little risk-free, a little careless in terms of taking a possibility. So this is same with the financial intermediaries. The banks do this very often because the money that they invest and do, it's not their own. It is depositors, right? So the depositors have to keep the required review, required monitoring and things like that. Central bank does. But at the same time, that requirement is there. I hope now you have some clarity for the concept moral hazard.
Yeah, thank you, sir.
Are you okay with that explanation? Okay. You see, the moral hazards kind of, expand to the point where now you see in financial regulation, they come to the extent where they restrict on asset holding by financial intermediaries. Financial intermediaries, they go to the extent of investing in certain type of assets which are actually good in terms of return, but at the same time would be beyond the risk capacities the financial intermediaries should be taking. So then the regulators might come and introduce restrictions, right? This is to prevent financial intermediaries taking too much risk. For instance, let's say the financial intermediaries try to lend only to the agricultural sector. And actually, some financial intermediaries only prefer consumer loans, right? So agricultural sector loans, yes. Some financial intermediaries too much specialized in that area. But what happens here is when you're too much exposed to agricultural sector, any weather-related problems happen. Any drought, any flood. I mean, these are cyclical in countries like Sri Lanka. Now we are, to some extent, with climatic changes that we are discussing, the probability of higher natural disasters of that nature is very much in terms of countries of our nature. So this has been factored in. And at the same time, you see too much exposing to one type of asset class. Loan is an asset in the financial intermediaries book. So 80% of your loans being gone to the agricultural sector. 80% of your loans gone to the consumer finances linked with salaried employees. Salaried employees, definitely you cut their salary when you are channeling them. Okay, salary is being channeled through the bank account. The bank account definitely look after that element. But what happened in a situation like this, where banks are not being channeled the entirety of salaries? Sri Lanka is good in that sense, but there are countries they have cut down when they exposed to financial distress. If their salary payments and things like that, countries have paid only 70% of their usual paycheck. So, as I was mentioning about the too much exposed into agriculture, when agricultural sector faced with these floods, droughts, and lose their regular income, if you have exposed all your assets to that type of economic activity, that financial intermediaries' books will carry a bigger share of non-performing loans, NPLs. So when your books carrying bigger share of NPLs, your ability to expand or take up new finances, new loans, get reduced. And then your financial books would not look good in the eyes of other financial intermediaries and reviewers. What happened there is they would not extend you new financial facilities. Even I was mentioning call money market, they will stop lending to you through call money market facilities. Always when they try to lend you, they will ask collaterals. Not only the collaterals, but with big haircuts. Haircuts means they take out a certain portion of value simply because they believe price volatilities. So you have to kind of see what type of asset these financial intermediaries can hold, what type of assets they could expose, but they have to limit those. So to say that the bank regulation would promote diversification. Promote diversification simply to reduce the risk. When it comes to diversification, we were discussing about what is this? You do not put all your eggs in one basket. If the basket falls, all the eggs will break. So you better put eggs in different baskets, not in one basket. So it is similar to you do not expose yourself to one type of economic activity. There are very good reasons in terms of financial crisis lessons where the financial intermediaries too much exposed to real estate, if not mortgage market, were the ones who really suffered during the financial crisis. Because the mortgage market collapsed, real estate prices collapsed. As a result of that, their net worth, these financial intermediaries' net worth has reduced. Okay, so the regulation has been introduced to promote the diversification. Don't put everything in one type of assets. If you are putting in one type of assets, your exposure limits has to be 1/5, only 20%, not more than that. Who puts these conditions? The regulator. They will come and review your books and say you are exposed too much to agricultural loans. Cut down. Okay. Similarly, regulators would come and put prohibitions to hold common stocks, ownership stocks. There is a single ownership limits when it comes to financial intermediaries. One person or one party cannot hold beyond that single ownership limit imposed by the financial regulator. Right? So why? It is up to, let's say, 10%, up to 20%. If not, in the case of Sri Lanka, a monetary board would allow exemptions to this single ownership limit by looking at the greater national and the financial intermediaries' own benefit. Otherwise, no. There are one or two instances they have let one or two financial intermediaries have higher single ownership limits because the foreign investors have brought in about big capital infusion. But after a kind of a duration, let's say after about 6-8 years, they've been asked to reduce that exposure, gradually phase off. If one person holds the entirety of that financial intermediary, there's a possibility that the financial intermediary would act upon that party's preferences, could act as a cartel. If he owns another financial intermediary and he has a big share ownership, he has the second financial intermediary, he holds a very big share of assets there too. So the financial intermediaries, both these financial intermediaries acting in consolidation would create the market uncertainties and also may not necessarily be in line with information available in the market, might lead to misleading market behavior, and they probably drive the entire market to a kind of a black hole kind. So the prohibitions come in the form of you have to limit your ownership, single ownership limits. So these were regulations. Why? Right? Rather than taking too much risk. So that's one way of requirement. Then from another perspective, you also impose capital requirements. Okay, we don't mind you expose yourself for more than 20% that we have set for one type of asset class. You can have another 20% if required, but you have to bring in capital. Capital is what? Ownership money. You bring in ownership money. You have to increase the capital requirement. So you introduce so-called risk-weighted capital adequacy requirements. So you give risk to these asset classes, okay? So you increase the asset class means you increase the risk. So higher the risk, you have to bring in higher capital to the organization. So higher capital means ownership money. Then the owners are mindful because this is their money. Your money at work now. Owners' money at work, not depositors' money at work. So when the owners' money at work, they themselves mindful to take up to this level as we take risk, not beyond that. Because anything happens, they lose the investment. So the capital requirements is also one way of addressing this asset concentration by financial intermediaries. That is also a regulatory measure. They introduce minimum leverage ratios. Okay, so the debt to equity, that is the leverage. So you create debt, but that creation of debt has to be up to a certain percentage of your equity. Up to 12 times. You can have a debt portfolio that could be 12 times of your equity defined, not 20 times, not 25 times. So this limits changes, varies from country to country, from time to time based on their economic cycles. But generally, a very, very interesting way in addressing some of these exposures, leverage ratios. Then you see, as I was mentioning, risk-based capital requirements. This is Basel. Basel is in Switzerland, one city. There you have an institution, bank regulators institution, where all the bank regulators from all around the world assemble and discuss the challenges and the ways to address them, and new form of regulations, new form of supervision arrangements being introduced and discussed, and training programs, capacity developments, all kind of financial intermediary related studies and regulatory considerations being looked at by the Basel institution. So what they are generally concluded in recent times is, yes, we had to introduce risk-based capital requirements. Okay, you engage in government securities, your risk weight is 0, because government securities are highly creditworthy. Governments have the capacity to pay in the form of, I was mentioning, either printing money or for that matter, even by imposing taxes, things like that. Right? So the risk weight you give for the government securities is almost zero. So you invest in a high credit worthy, we looked at credit rating, right? So high credit rated institutions in the investment grade, your risk weights are lower, right? So you invest in those assets, your risk weights are lower. You invest in fastly moving certain economic activities, essentials, right? You cannot keep those economic activities as something that changes with other related macroeconomic developments. No, that is reasonably permanent. People have to consume those stuff. Then you give a low weightage of risk. But when you expose yourself to risky avenues of business, for instance, tourism, actually during this period of time, so then you give a lower, the higher risk weight, right? So you give those elements into the equation and calculate your capital on the basis of risks that you are taking. You give weights to economic activities. On the basis of that, you define what's the capital level you have to have in the organization. Then also there's a concept in terms of capital requirements, which is called regulatory arbitrage. Okay, so this is actually financial intermediaries try to, okay, capitalize on loopholes in regulatory system, right? So to circumvent unfavorable regulation. This is like tax. There are some tax components there. So you see, you have to pay that tax only if you take up such economic activities. So you try to not to take up that economic activities, or you try to kind of mix that with, let's say, a domestic economic component into the equation. For instance, you might require to pay certain percentage of taxes if you use credit card payment for foreign payments, foreign kind of purchases, foreign kind of activities. So to say you avoid such in the first place, even if you are effectively doing it, you basically do that through an arrangement where a domestic party engage. So the transactions would first channel to the domestic party and effectively see that as a domestic transaction in the books of the financial intermediary, and then you would not be paying. So the regulators also aware this type of possibilities. This is a one example I just took. There are many number of examples of regulatory arbitrage. Even I was mentioning the government securities where the risk weight is zero. Effectively, risk weight is zero for shorter tenor government securities. But longer tenor government securities, the risk is there. Longer the duration, uncertainty is greater. We have discussed all these things. Right? So longer the time from now, 20-year maturity bond to 20 years from now, you don't know what could happen. Very difficult to project, very difficult to predict. Right? So you have to have a weight. So to say that, yes, zero risk generally for shorter tenor, 1 year, within 1 year, zero, fine. But generalizing, if somebody has introduced a general regulatory weight in terms of government securities, irrespective of maturity consideration, then the financial intermediaries would circumvent that type of regulation by having a longer duration bonds also in their portfolio, because longer duration bonds are good, because one basis points, that is 1/100th of a percentage point change in yield rate would have a higher price difference. So they have a higher profit probabilities. right? So all being said, I mean, these are the ways through which these capital requirements being introduced in today's regulation to make sure the banks are not exposing too much into one type of assets and thereby increasing the risks. Okay, so the attempts to restrict financial institutions from risk taking being addressed through this type of regulation and this type of capital requirements being introduced in today's financial intermediation, right? Any questions before I move on to the next point? Have questions? Yes, we'll move on. So the next point in capital requirements is government imposed capital requirements are another way of minimizing moral hazard. That is minimum capital requirements. Risk-based capital requirements, as you take more risks, you have to have more ownership money being infused to the financial intermediary. Right? So what you are seeing here is you are basically introducing minimum capital, right? So through that, you discourage anybody who is trying to establish a financial intermediary with intentions to impose moral hazards and also probabilities of taking risks beyond what is required. So you require a certain big volume in terms of capitals. In Sri Lanka's case, it is now 5 billion rupees, but that is just a technical conclusion only, because capital requirement changes with risk-weighted capital adequacy requirements now. Okay, so the risk weights would play a very important role in today's context, and thereby the requirements to have capital. And because of that reason, even if the financial intermediaries make huge profits, banks are not allowed to distribute those profits in certain periods, simply because they've been asked to retain those earnings. So the retained earnings are also part of capital funds. Who owns these funds? The owners. So these funds are owned by owners, also maintained as a buffer, right? So these all requirements are very important, apart from bringing in capital requirements for financial institutions to reduce moral hazard, because they probably come in with the expectation that, okay, I will put a smaller investment and then let depositors to build the portfolio. Through depositors' money, I would try to engage in economic activities and make a reasonable profit, right? But he himself has to bring in the basic minimum capital in the first place. That's why I was mentioning in the previous one of the slides where, yes, you can take risky avenues, but then you have to bring in ownership capital, ownership money. So then he is mindful. But here, minimum capital itself creates a requirement for them to have a sizable investment in the first place to avoid possible moral hazard. Okay, so moral hazard invariably kind of, attract people to come into financial intermediation without effectively investing into the financial intermediary activities. So the minimum capital, risk-weighted capital, other capital requirements try to address those possibilities. And this capital imposition also has various forms. One form is based on leverage ratios. Okay, so the leverage ratio is the capital divided by assets, right? So capital, let's say 5, your asset is 100 billion, capital is 5 billion. Okay, so you can see capital being divided by your assets. So it is 20% effectively, right? To be classified a well capitalized, a bank leverage ratio must exceed 5%. Okay, low leverage ratio that's below 3% triggers increased regulatory restrictions on banks. Higher the leverage ratio is good, not lower the regulatory ratio. Right, so you've been looked at this based on the economic circumstances. X, Y, Z numbers here, you don't need to kind of take it as yardstick, simply because this changes from case, the country to country, different periods of time in the business cycle. These could be different because you would require certain type of economic activities to happen. If your economy is in a growing pace, you require to take little more risks than a country in a mature place, right? So the leverage ratios could be different, but what matters here is these capital requirements could also be looked at in the form of leverage ratios, the capital to assets. Okay, you can have assets, huge asset portfolios, but you have to back those asset portfolios with capital funds. If you have a very low capital funds, right, so your leverage ratio is low, that is not good. That's the message. So the regulators, when they see the leverage ratios are declining or low, they would be keeping a very close eye on those financial intermediaries and push those financial intermediaries to increase capital by bringing in new money, or they've been requested to not to distribute the profits that they earn. So retain profits. Okay, so the second type, as you already discussed, risk-based capital requirements. So you can have economic activities, no restrictions of economic activities. You can engage in activities, some are very risky, but then you have to bring in required capitals. Right? So this, the leverage ratio, capital on the basis of risk base, is very important yardsticks that you will see apart from minimum capital in today's capital consideration among financial intermediaries. Right? So then you see with respect to financial supervision, any question before I move from the previous points that we discussed? Right. So next point is financial supervision, which is a chartering and examination. If you have put down even in the form of messages, I could read it if you have any questions. But this is a very interesting area that we are discussing in today's financial markets. As this supervision happens through chartering and examination. Examination is very interesting because there's the concepts called on-site and off-site examination. On-site, you visit to the site and do the examination. Off-site, no, you don't visit, but financial intermediary has to submit regular reports to the financial regulator. So through such regular submission, financial regulator knows the health of this financial intermediary. So these examinations also could be scheduled or unscheduled. So when it comes to on-site, you see there's a cycle. every 3 months, a team of regulators visits to the financial intermediary and look into the books of financial intermediary, or they take up the areas where they had already earmarked through off-site, right? Off-site examinations that they have carried out. These are regular scheduled ones, but at the same time unscheduled. All of a sudden, the financial regulators visit your organizations and get into details and look into the books, the systems that you are practicing. Okay, and also immediately compute the capital requirements and restriction on assets to prevent moral hazards, because in the financial markets, asset prices change very frequently. Today's price is not the same as what was there yesterday. Even exchange rate, interest rates, these changes very frequently. With those changes, prices of the assets also changes. Right? So with that, the capital adequacy requirements, risk-weighted capital adequacy numbers also changes. Asset quality changes. Maybe a good asset in your portfolio, with the change in interest rates, become a bad asset. Change in exchange rate would become a bad asset. Management, people who run the financial intermediary, because the retirement of a senior management or a new recruit to the treasury or the corporate management has created a lot of considerations in the eyes of regulators or the financial market, because he is not reputed. Right? So that's why when it comes to management, there is an element called fit and proper assessment of senior management of financial intermediaries. Fit and proper. I mean, this is not evaluating his physical fitness or anything, no. So whether that person is suitable in terms of required characteristics to hold a position of that nature, whether his moral background is sound, he has not exposed to any unethical kind of activities and records. So to see that fit and proper, he is fit and proper to take that responsibility. This is a very common assessment among all the senior managements in financial intermediaries. There are people who has blacklisted. Their presence itself creates a doubt in the eyes of other financial intermediaries. So they themselves keep away from that type of that type of people's financial intermediaries for engagement. They do not engage with them. Then they look at earnings, liquidity, sensitivity to market risk. What happened? 10% adjustment in interest rate. 10% adjustment for 10% of interest rate is 11%. So when the interest rate changes from 10% to 11%, what happened to the portfolio? By how much the prices of assets in the portfolio declines because interest rate increased from 10 to 11. Exchange rate, people risk, all being sensitive. These are market risk, inflation risk, political risk, now pandemic risk. So because of that, we have so-called disaster recovery sites, DRS sites. We work from home. How the setups in the now the class has been conducted from remote arrangements. How effective these in terms of direct discussions against virtual discussions. So all being factored in. Right? So you factor all these things and see there's limitations in terms of capitals that you hold, or assets that you are exposed to, or you are taking moral hazard probabilities, all being evaluated, all being looked at. Okay, so what you are basically seeing is even this sensitivity kind of things being run through ready-made models, Monte Carlo simulation. There is VAR models, right? There are so-called dynamic stochastic general equilibrium models. There are various packages and models available, but these are not names for you to kind of, just to have a picture. But interestingly, these examinations, these are scheduled, unscheduled, for the purposes of requiring monitoring the capital, assets qualities, whether these agencies take moral hazard, right? So this is examination. But prior to that, you see also the chartering. Chartering is you review the proposals for new financial institutions to make sure you don't make a adverse selection. Even the regulators could make adverse selection. So to make sure that the financial intermediary that they are proposing has capital, quality people with required fit and proper considerations. They have required infrastructure. You can't be a financial intermediary by having a place of business. No, you should have systems. You have treasury management systems, integrated treasury management system, integrated risk management systems. And today's financial markets, you not only have those facilities, but also should have capacity to link up with your entirety of branch network, global network through SWIFT messaging, secured financial transactions arrangements. They are huge requirement in terms of infrastructure. So these all being looked at. Right? So even now, some banks being given license, they are mainly operating through supermarkets for the time being. So they have a branch network, but effectively, whether those branch networks are linked with one another, how that mean again come to a centralized operations of treasury management, the liquidity being managed. There are various ways of looking at these, screening these proposals, and this being called chartering. Then also the examinations is we discussed scheduled and unscheduled with all these subcategories within. And also filing periodic call reports. You have to have every day, you have to send a report to the financial regulator of your assets, changes to your assets, right? What's your transactions? Maybe a summary, but the systems would capture the details of one and each and every transactions that you have entered. Because you probably see some of the assets like government securities, let's say, those are electronic, not paper now. So electronic entries of those transactions require to be closely monitored. So you give the 5-year treasury bonds purchase, 5 billion, sold 1 billion, net acquisition is 4 billion, all the details. But within that, maybe 100 of transactions. That details are there. So whether that's matched with the system's number. So all being monitored. Periodic financial statement, periodic reports on people who manage the treasury, senior management, and things like that. So these are the ways through which the financial supervision take place in today's financial intermediaries. Right. So another very, very important area of assessment is risk and the risk management. If I come to this point, any questions? Any questions here? Right. So you see here the assessment of risk. What you are seeing here is the soundness to evaluate the management processes for control in risk is one aspect. So to say that, let's say you have decision-making authority levels. For instance, if you are working in a treasury, you probably know, or you are a dealer, you probably know, single dealer limits being introduced. A single dealer can make decisions with respect to transactions up to, let's say, 50 million rupees. When you go 50 million rupees transactions up to 100 million, dealer plus chief dealer has to evaluate that proposal. Dealer cannot do it on his own, but he has to have the consent of the chief dealer too. But if it is beyond 100 million, but up to, let's say, 500 million, it is the dealing room committee, dealer, chief dealer, and some other management. So to evaluate that investment decisions. If it is more than 100 million, CEO plus the dealer committee decision. If it is more than 1 billion, board of directors. So the way in which the management process is established. But then the markets are very quick. I mean, the prices change now, next second is different. Rates may change. New information would come in and change the perception of the market to kind of see where the markets are currently standing. So what happened here is you may have all that management, but interestingly, if you take ages to make that decisions, by the time you take the decision and come back, the market would be different. Right? So then what you are basically doing here is you have to have certain type of systems, processes. Maybe now in the treasuries and financial intermediaries, they have system of electronic prompts. Like you have the mobile, you get a message that prompts some alerts being established. So similar to that, when the transaction is there of more than certain value, as I was mentioning, the required party is being prompted then and there. So you have to either consent or you have to reject. You have to give your observation immediately. So it's a matter of pressing another button. So when that being pulled, final decisions being taken, including board of directors, if the transactions volumes are required their consent. Then how the arrangements within, whether you have risk measures in terms of recording of activities in the treasury, entering of transactions, whether those being captured at each and every point of transaction entering, because these are big financial volumes. People with ulterior motives could make significant benefits gains through possibilities within if you don't put in place all these risk processes. So the assessment of this risk management is part of this regulatory process. Regulations would get into these details when it comes to assessments. through which they try to control the risks. And effectively, these systems driven, and then of course evaluation driven by regulators and internally within the organization, the infrastructure requirement in terms of those assessments and maintenance of books, maintenance of CCTV even for that matter. These are all part and parcel of risk management possibilities today. And then there's the element called risk management arrangements in organizations, where asset prices changes by certain percentage has realistic prompts to take actions. There may be guidelines and decisions. If the asset prices changes by 15% within 24 hours time duration, you have to make a sell or buy decision. It's a very much said, because financial intermediaries don't want to wait. Okay, today prices drop, tomorrow it will revert, day after tomorrow it will revert. You can't be just continuing like that. You have to make your decision on the basis of where the markets are. If you are exposed too much, you have to make a call, you have to get rid of that position. Maybe even at a 10% loss, not letting that loss to increase to 20%. Similarly, you may come to a point where financial intermediaries being requested by the board of directors or the management to say that the regulatory decisions are followed and no single regulatory complaint being entertained. So that means if a single regulatory complaint comes from the regulators, the board of directors would assess. So not only assess the practices there, but also as a practice of risk management, once the manager, senior manager responsible exposed to, let's say, 3 regulatory complaints or complications, probably he been transferred, if not demoted, not promoted. So all these are possibilities. So this has been established through a trading activities manual in the case of US for risk management. This trading activities manual subsequently changed. This is 1994 one, but subsequently this has been further expanded with new versions. But what it basically says is oversight, the policy adequacy for risk activities, measurement and monitoring systems, and internal controls. So effectively, to put in place a risk management structure within the organization. Then you also look at risk limits in the form of interest rates, exchange rates, kind of things. You have to establish internal policies, then management and monitoring of such policies within the organization, right? And also stress testing and so-called value at risk. These are all methods through which you compile and compute your risk exposure. Stress testing is you give a stress. It's like you give your own self-assessment, how long you can hold your breath to make sure your lungs are perfect, especially during this period of time. Or at the same time, you try to kind of smell whether you get the smell of certain type of things to make sure you are not COVID exposed. So to say, I mean, these are stress tests. So similarly, within the organizations, they have this stress test in place to see whether you are exposed to interest rates risk. Okay, so these are risk assessment tools. Any questions? Any questions here? Right. So we can move on. Another requirement in terms of regulatory arrangements is disclosure. You have to submit certain reports periodically, and also you have to have certain reports published on a regular basis, and also you have to adhere to standard practices, for instance, accounting practices. You can't have accounting practice that not in line with international standards of practice. So that you can compare your accounts with the accounts published by another financial intermediary in another jurisdiction. Otherwise, what happens is your accounting standards are different to the accounting standards of the other jurisdiction. So you are not comparing apples to apples. So you will not be able to figure it out how much the risk exposure of your bank against the bank next door, if not in the next neighbor country. So the requirements in terms of disclosures are audited, non-audited, within a 3-month horizon after a completion of a financial year or a semester, not semester, quarters. So this is required to be filed. Either if you are listed, there's another set of requirements in terms of listing requirements by the stock exchanges and the Securities and Exchange Commissions. Right? If you are a public listed, you have those accounts. So to make sure you are reducing the information asymmetry. So these disclosures would create more information. So you are moving towards information symmetry, not asymmetry. So there are accords in terms of Basel agreements, Securities and Exchange Commission agreements on these minimum standards of disclosures. There are acts in terms of accounting oversight boards. These specific acts you don't need to remember because that's specifically to some extent US. But Sri Lanka context too, there's the guidance in terms of those accounting standards and things like that. And then the requirement in terms of if you are a listed company in terms of stock exchanges and Securities and Exchange Commissions, that's there. Then mark to market requirements, where you have to mark your portfolio every day for pricing. That's why you don't manually do these things. You have systems in place. Press of a button would do the needful in terms of valuing all your assets in terms of price movements, price behavior in the market, and ultimately you will have the entire assets portfolio. Some assets would have increased in price, some would have decreased in price, some decreased, whether that has breached the red the direction, that means the color lights, like you have red, amber, green, whether you are in the green zone, whether you are in amber zone, you are in the red zone. Then you have prompts to divest, if not sell those assets, right? So these are prompts through mark-to-market arrangements in terms of accounting as well as portfolio valuation on a regular basis in financial intermediaries, right? So these elements are very interesting. And then, of course, you see consumer protection. Consumer protection is now another aspects in regulation. The financial intermediaries previously not treated their clients in line with consumers. For instance, there's a concept called consumers are the kings, right? So you had to make sure their interests being protected at all the time. So there are legislations being put in place. In Sri Lanka too, there's a regulation now in terms of the Banking Act, but at the same time, there are some regulations to protect the consumers, but not necessarily financial intermediary related. Those are for other kind of things, but Banking Acts look into these customer protection and things like that. So the subprime mortgage market crisis again opened up more requirements in terms of this consumer protection and customer protection, because certain segment of the society also suffered because of the very low standards of credit evaluation practiced by financial intermediaries. That is principal agent problem we discussed. Right? They not even looked at the soundness of the borrowers, whether they even have a permanent employment, whether they are legally allowed to stay in US. All kind of problems were there. Right? Then the CDOs and things like that. So there are a lot of areas of consideration with respect to the consumer protection. This is also a part of regulation in today's context, through which they try to address asymmetries to great extent. So this point, you probably see the discussion so far today. I was taking you all with greater details because this is very important in today's context. Because the pandemic and other related possibilities would not necessarily provide total information required for an effective, informative, informed financial market decision. So these regulatory requirements are in place to make sure some of those being addressed and asymmetry being reduced to the full possible extent. Asymmetry cannot be taken out completely. Even if you have same information, two people would have different capability to review them based on your capacity. So then asymmetry is there. But minimum standards of requirement of information is required to be submitted. So I believe this is a point I can stop and start our discussion next week.